Hello. In this video, we're going to review a few common financial transactions that manufacturing companies and other types of companies encounter as they run their businesses. So before we jump into it, why is finance important? Why even study this stuff? Well, everyone at the company needs to understand and speak the language of finance, because it really is how you communicate in the world of business, using that financial language. So it turns out that finance is more logic than math. Most of the math is pretty straightforward and basic. Addition, subtraction, division, some exponents if you're getting crazy. And there is accounting that's happening behind the scenes as these financial transactions occur. So it's good to understand some of the details of what's going on. And we've got some finance overview videos that you can watch for a little more detail about financial statements, financial ratios. Okay, let's get right into it. We're going to show you a few examples that demonstrate the flow of money through a company. Here's a game board that we'll be using for our exercises. And you can see that we've got a high-level income statement and balance sheet depicted on this board. The statements obviously have much more detail, but we're just trying to focus the line items on the ones that we'll use and the points that we'll make in our exercises. And the coins that we'll be moving around, we'll say, are worth $1 million. The gray coins will be accounting dollars, and the pennies will represent cash. Let's go ahead and set up the financial statements for the current condition of the company. So let's say that you have $2 million in cash on hand, you've got $8 million in stock, and $6 million in retained earnings. You also have inventory on hand that costs $12 million to produce. That includes both labor and materials. If we go ahead and play this out, if you'd like to pause the video as you kind of work through the example, go ahead and I'll be right back and show you how I did it. All right, well, here's how I did it. First off, we say that we have $2 million in cash. Nice. So we'll represent that with 2 pennies, because we said that the pennies will represent cash. So we've got $2 million in cash. Say that we have $8 million in stock, so boom, put that down in equity. But you notice I didn't use pennies because stock is not really itself cash, right? It's a representation. It's an accounting concept. Cash is cash. Everything else is a concept. Not that it's not important, it is, but we want to keep the differentiation between the two very clear. So I've used the gray chips for stock. We have $6 million in retained earnings, which are the earnings that we didn't pay out as dividends, at least not yet. We've retained those earnings in the business. So you see that I also put up the inventory, $12 million, labor and materials that it cost us to produce a bunch of pencils that are sitting in inventory. And you see that the balance sheet balances in terms of the assets and the liabilities and equity added together. So each equal $14 million. And hopefully you got the same thing as you played it through. So let's say we're going to sell half of our inventory. And the price that we're going to sell it at is a total of $10 million, and we're going to get paid in cash. We've got to pay SG&A, which is selling, general, and administrative expenses of $1 million, and we're going to pay that out in cash as well. We're going to pay taxes of $1 million also in cash. So how do the financial statements look at the end of the year? That is your task. So we can use the same setup that we had established for our company. And if you'd like to pause the video and work this through yourself, feel free, and I'll be right back. You can see how I did it. Okay, so let's work this through. We sold some inventory and we paid some expenses. The first thing is that we got revenue of a total of $10 million in cash. So on the income statement, I represent that with the gray coins, $10 million, and I also have cash of $10 million that's coming in. We also, though, are going to match to that $10 million in revenue $6 million that it cost us, because we said that we sold half of our inventory and half of the 12 million that we had is 6 million. So we are now matching them, the matching principle, match revenue to expenses in the period in which we're trying to calculate profit. So I moved that 6 million. It's no longer in inventory. We sold it. It's now cost of goods sold. We've got $1 million of SG&A, selling, general, and administrative expenses. But we said that we paid those in cash. So boom, $1 million in cash goes out and we're down by $1 million. We also said that we had to pay some taxes. So we go ahead and show that as a tax expense on the income statement, and it's $1 million that comes out of our cash. So we got net income of a positive 2 million. Nice job, and now we got one problem though. Our balance sheet does not balance. We got 16 million on one side, but on the other side, it looks like we've only got 14 million. Where's the difference, and how do we make that up? Well, if you did it like me, you know that profit, whether positive or negative, flows through to retained earnings. Unless we pay it out as a dividend, which I didn't say that we did. So it's going to stay within the company as retained earnings. So there's your missing $2 million, which means that it totals 16 and 16. Luckily, the balance sheet, once again, as it logically has to, and actually balanced by the end of the transaction. So now, let's go ahead and say that you bought a machine. So go ahead and clear the board. And we'll say that the coins are now worth $100,000 each. So we're going to change the value of the coins. So here's some details for you. You're going to borrow $1 million in cash. And the thing is only due, this loan is only due in 20 years. And we're going to get that money on January 1st. And so we're going to buy a machine for $1 million in cash. We're also going to depreciate that straight line evenly, which is what that means, or expense it evenly over a 10-year span. So how do the financial statements look at the end of the first year? And then also think through how the financial statements will look at the end of the 10th year. Again, if you'd like to pause, work it through yourself. I'll come back in a minute and show you how I did it. We bought this machine. We borrowed some money. How does it look? Well, first, we borrowed some money. $1 million. You said the coins are worth $100,000 each, so we got 2 stacks of 5. Got a bunch of debt sitting there, $1 million. Luckily, it's at 0% interest, not due for 20 years. But what it does, it raises our cash level at the company. So we now have $1 million in cash, and we're going to convert that cash, as I mentioned, into a machine. So as I start to use that machine, we said that it was depreciated for 10 years evenly. So at the end of the first year, what we would have done is actually used up 1/10 of the useful life of that machine. So we have a depreciation expense of $100,000. That's an expense on the income statement. And that also is represented on the balance sheet by $100,000 in depreciation. So now if we play it through, we've got a negative impact to profit of $100,000. Now our balance sheet doesn't balance. How are we going to get this thing to balance? Because we have the accumulated depreciation. So the book value of that pencil making machine is now not $1 million at the end of the first year. It's $900,000. But that's reflected only on the asset side, not on the liability side. Liabilities and equity side. How do we make that play out? You probably guessed it, whether it's positive or negative. The profit you make in a given year contributes to retained earnings. Again, whether it's positive or negative. So now if we play it through, you can see that we have the value of assets at $900,000 and the value of liabilities plus equity equaling $900,000 as well. Now if we play this out, I won't do it on the game board, but if we play it out over the 10 years, this is what the flows would look like. In the first year, we just went through it, you'd have the $900,000 book value. In year 2, you've got 2 of those $100,000 yearly depreciation expenses, which means book value of the asset, $800,000, and so on, such that by the end of the 10th year, book value is 0. Let's wrap up the exercise by talking about what we covered. The balance sheet, as you have seen, always balances. It has to, it's logic, and it must balance. Profit, though, is not always the same as cash. There's accounting that's happening behind the scenes of these transactions. The income statement and the balance sheet are integrated. They're different lenses that are used to describe the operations of the business. Well, thanks for walking through some of those common transactions. If you want to learn more about finance and kind of refresh your skills, we've got some finance videos up on our YouTube channel. On our website, we've got some references and tools as well. And feel free to join our LinkedIn group or our company page. And if you'd like to contact us, feel free. Thanks a lot for watching.